welcome to another Hola Prime Academy video. In this video, I will discuss a mechanical trading system that beginning traders can put to work that has simple rules and is very easily identifiable as a potential setup. In this video, I'll go through a mechanical system, and a mechanical system just means that it has a very specific set of rules. For example, can think of it more like a computer program, like an if-then statement. If something happens, then do this. It's pretty easy to identify when the setups happen in this trading system. And by its very nature, it has you aiming for a positive risk to reward ratio. So it has all of the components that a new trader might be interested in. Again, the simplicity is the genius in this little system. And while it's not overly complex and it may not be the most flashy of systems, over the longer term, it does tend to work. So with that, let's take a look at some charts and I'll show you how the daily breakout system works. Okay, so I have a daily chart of silver, and on it I only have one indicator, and that is the 20 EMA. So it's 20 exponential moving average, 20 days. And you'll notice that over time, the market will look at this indicator and move it in one direction or the other via buying and selling. And all this simply means is that over the last 20 days, with a little bit more attention paid to the last handful of them, the market has been moving either higher or lower. Now, notice the candlestick that just formed in the previous session. It was as the 20-day EMA is starting to lift off a little bit. You can see that it just took off to the upside, and so did the EMA. So the concept of the daily breakout system is quite simple. You want to trade in the direction of the 20-day EMA. And I would also point out that really you want to trade in the longer term trend as well. So in this case, it has started to go higher. Over the course of the year, you can see that silver had risen from $22 to $34. There have been a few pullbacks here and there, but longer term, it's a bullish trend. Granted, you could have gotten hurt if you bought a ton of silver up here and the market pulled back. But overall, generally speaking, over the last year, if you bought silver and hung out long enough, you made money. So going back to this thought process that the market has been rising for some time and the 20-day EMA is starting to curl higher, this attracts my attention. The first thing that I will do is I will note that the 20-day EMA is starting to show signs of bullish behavior. And then I will draw a line, a horizontal line on the chart that reaches the high of the previous session. So in this case, it's at the $32.26 area. Then I zoom into the 1 hour chart. I will go ahead and click on chart auto scroll, so it'll go right along there. And you can see that line is right there. It might need to be cleaned up a little bit. So I'm now at $32.273. And now I take and click on the properties of the MetaTrader platform. And this is just for simplicity. You click on show period separators. And on the hourly chart, it'll break it up into 24 hours a day. Now, we're not quite done with this day, so I'm focusing on this day here, that high. You have the low here. So the first thing that I will do is I will put a line right in the middle of it. So you can do that via the Fibonacci retracement tool if you would like. And you'll notice that I'm basically right where I need to be. 50% Fibonacci retracement level is 50% of the day. Now you can place a buy stop just above this area and then a stop at that 50% level. I'll go ahead and zoom out a little bit so it's a little easier to see. Now that sets up your protection. That sets up your entry and your protection. At this point then, you need to take the distance between the two all the way down to the bottom of the the trading day that you're basing this off of. So the highs and the lows. And then there's your target. Quite often what you'll see, although not always, but a lot of times what you'll see is that when you lay out your target, you start to see an area that's been important previously. It's not a major area, but you can see there has been a reaction here to this $33.70 area. So if we break out to the upside, what this means is we are risking this to get twice the return. We're going with the short-term momentum. We have broken above the previous day's trading range, so that will trigger anybody who was short in the previous day. They will have to buy their position back or lose a ton of money. And then, therefore, you are going with the momentum. You are seeing a continuation. The idea, of course, is you're just simply following the trend. So let me go ahead and pull up another chart here. And in this case, I have the NASDAQ 100. Now, I would point something out to you. This market has really fallen during the trading session after initially rallying, but the 20-day EMA is rising. So you look at this through the prism of the range of the day that you would be using for reference, the previous one, and we're already below it. So this is no trade. I'm not saying that this couldn't be adapted for a shorting strategy, counter trend strategy, but for simplicity's sake, we will take a look at the previous day, which is over here, and we are below it, and we're not going with that daily trend. So this is a situation where you just don't bother with it. On this chart, the US dollar against the Swiss franc, you can see that it had been rising, but the 20-day EMA since then has flattened out a bit. So this isn't necessarily a setup I like. I want to see a little bit more momentum. Now, I'm not going to lie to you. As somebody who has traded the markets for a while, I would look at this and probably be somewhat bullish. But I also recognize that for a newer trader, you're better off just waiting for a nice mechanical entry. In this chart, we have the New Zealand dollar against the Swiss franc. Now, I will do the same thing that I did previously. So I'll draw a line at the top and the bottom of the candlestick from the previous session. I will change over to the 20-day EMA, and you'll see that it is very negative. It's a very bearish pair at this point. You go over to the 1 hour chart, and I'll click on show period separators. And now you can see that we are getting fairly close to the lows. So we go back to our setup candlestick the previous day. We measure the distance using the Fibonacci retracement tool. So this is the 50% Fibonacci retracement. So what I will do is put my stop loss there. And my entry's down here. So you are risking basically about 31 pips. You want to double that size of the candlestick. So that should work out to about 60 pips or so, 61 pips. So your setup suggests that you would be aiming for right around 0.5050. And notice how the market had bounced pretty significantly from there previously. But again, you have a situation where it is a mechanical risk one to gain two type of scenario. I will pull up one more chart just to drive the point home. In this case, we're looking at the euro against the Canadian dollar. Now, at this point in time, as this wide candlestick is closing, this is how I would set up my trade. So when the charts change over, and they will here in about an hour, this is how I set up my trades and forget about them. So as I was showing you earlier, the mechanics of how the trade would have worked during the day, this is how the trade sets up if you're perhaps going to bed and just want to place the orders. So nice wide candlestick. So it does give us some room to play with here. Let's go ahead and set up our 50% fib. Looks like we're right about there, give or take a pip or two. Notice how the 20-day EMA is racing higher. So that's a good, healthy sign. And then you just take the measured move of the entire width of that candlestick, and you're aiming for 1.5082. You are risking roughly 52 pips, and you're trying to get about 104. So you can see how that plays out. But speaking of the previous candlestick, for example, had you taken the trade from the previous day, this is what a loss would look like. You would have been stopped out for a roughly 32 pip loss because we did break above the highs of the previous session. And then subsequently pulled right back. So this 30 pip loss, of course, you wouldn't have enjoyed it, but had it gone in the correct direction for you, you would have made 60. Now, over time, the idea is that overall, if you are following the trend and you're gaining every two for one you're losing, well, that means you only have to be right about 1/3 of the time. Mathematically speaking, you will earn enough in one victory to make up for two losses. Furthermore, you have to keep in mind that you're following the trend, so your odds of winning are probably going to be better than 1 out of 3. Now, there are some other variations of this breakout strategy that you can use. For example, you could use a triple. So what I mean by that is the candlestick before that you're now playing the trade off of, maybe try to get triple the height of that. Recognize, though, that it takes a lot more work to make that thing pay off. But again, if you're going 3 to 1, that means you only have to be correct something like a quarter of the time. So this is a neat little mechanical system. You know, you can see that it doesn't always work. I did show you what a loss looked like, but the victories will outpay what the losses will do along the lines of the trend. It is when you start fighting the trend that you run into trouble. So that's why in the NASDAQ example, I just said it's not really worth trading it yet, mainly because we broke down below the previous candlestick. So with that being said, I like the idea of making things as simple as possible. And I do recognize that over time, statistically speaking, going 2 to 1 or possibly even 3 to 1 will make you profitable, assuming that you're following the overall trend. This does not work as well inside range bound type of markets. So for example, if the 20-day EMA is relatively flat, like it was back during the month of March in the euro against the Canadian dollar, you might find some trouble. So again, you want to see some type of trend, and then you're just simply triggering your account to follow that trend.